In this video, I'll be covering what now after the election. Honestly, it was pretty surprising. I thought Biden was going to win by like a much bigger margin. Not that I'm supporting him, it's just my expectation was that he was going to win a lot more based on the polls and all that, and also on the fact that Trump promised to reduce government spending, drain the swamp. None of that happened. 2016, he was like the wild card. He was asking for people to like give him a chance. Now he's just doing a politician. He probably will be ending his term, adding more to the national deficit more than Obama's 2 terms. Stuff like that. But um, it seems like Biden is going to take this one. And without the Senate, I think maybe some people are thinking, they want Trump out, but they don't want to give Biden too much power. So maybe they voted Republican for the Senate. But either way, Biden will definitely spend more than Trump did, especially when this bubble is so much bigger now. These are the topics that I'll be going over today. Remember, please keep in mind, again, this is all just my personal, humble opinions. They're not investment advice. Please do your own research. First of all, let's talk about what a Biden presidency mean. So it is unlikely that they'll get the Senate majority that they were really hoping for, because if they do, then they control all 3 branches of government with Congress, Senate, and the presidency. Then they can, pass bills a lot easier, like what the Democratic Party was trying to propose in terms of the next round of stimulus of the $3 trillion bill. But I still think some Republicans will still sign on to it, maybe to both just to like not look like an asshole for their constituents, because everyone thinks they need stimulus, even though it's really, again, Wall Street's gain for Main Street's pain. But everyone's so blinded about the cash that they get right away now. No one cares about how they're like, no one's care or asking how it's being paid for. Everyone just think like, someone else will foot the bill. And Biden also promised higher taxes. So he can either some Republicans will buy into higher taxes in the Senate, or he can do it through an executive order, just like what Trump did with the tax cuts. And so not only is he going to just reverse Trump's tax cut, he's also going to hike it higher. So not only does the market have to price out the 2016 rally from there because of the lower corporate taxes, they also have to price in the higher tax hike. And what's worse is, another thing is, he talked about hiking capital gains. So these rich people who have some gains this year or over the years, there's a high possibility that we see a sell-off in the future before year end, because they want to lock in their gains now before the capital gains taxes get higher next year and in the future. And also higher corporate tax rates mean there's less profits and less profit with factoring future cash flow factoring. Therefore, the stock prices will also be lower because they're not returning as much value to shareholders. The Democratic Party and with Biden presidency will, they always become bigger spending, bigger deficits, and that will bigger spending because they want to do a lot more programs. That becomes more bigger deficit because they're not going to try to tax the middle class maybe by little, but their focus is going to be on the rich. And what happens is, when you tax the rich, history have shown time after time, they find ways to not pay the tax, either put it in tax shelter vehicles, or they have a lot more options, and people react to different policies, and they do that to avoid taxes. So that means bigger deficit, and that means is more Fed money printing by Fed buying the treasuries off secondary market with freshly printed currencies. And finally, the Democrats focus on green energy. Not so they floated the idea. The Democratic Party floated the idea of the Green New Deal with $100 trillion. Now, I personally understand the need for climate change. It's just my opinion. I don't think we can immediately replace everything from an oil-based or fossil fuel-based economy or globally into completely green energy, not only because they are not as reliable like wind and solar, and they also use a lot more land mass, and they like the solar panels, they like the good ones last about like 10 years, but the recent massive production from out of China, those last about 5, and there's currently still no good recycling or like program that deals with all the bad or like used up solar panels. That's one. For wind, if I think if it's in on land, it will last about like 10 to 15 years. It might be low. I think it's about 15 years on sea. But what happens is the salt eats into the blades, and also the whole production of these giant blades require a lot of energy, which again, the carbon footprint on that, but I think it pays itself off after 6 months. But obviously you have the problem of killing birds, there's that too. I think unless, which is why I'm also bullish on uranium, is that unless the Democrats realize they can't just push for solar or wind. Hydro, also another problem is, it's just floods, and US doesn't really have like that big of a river like China does. So unless the Democrats really look into nuclear, the push on green energy is going to be troublesome. But regardless, they do want to somehow reduce the production on oil, push for green energy. I will talk about this later on the oil slide or energy slide. So let's talk about the bond market. So unlike the normal inverse relationship with stock market, where stocks goes up, bond goes down, and bonds goes up, stock goes down. Like in the week prior to presidency, bonds actually sold off a little, or it didn't rally up, meaning the yields didn't fall. And this is showing real trouble as investors are starting to not look at bonds as the safe haven. And Fed mainly has a stronger ability influencing the short end of the treasury market, and it's slowly losing control of the long-term yields, as you can see at the 2s10s differential. So unless they go in there and massively buy up long-term yield, which could send more alarming news to the market. What I expect once inflation expectations start ramping up, once the 10-year treasury move up to 1% and 30 years move to 2%, then you're going to start seeing a lot more people paying attention. And in my opinion, like the stock market bubble is one thing, the bond market for the length that it has ran, that thing has a lot of air that has to come out. Now let's talk about the US stock market. A lot of people were thinking like the blue wave was going to be the best scenario, because what happens is Democrats want more stimulus than the Republicans, and if there's a blue wave, meaning they control all 3 branches of government, so they get retain the House, get the Senate, and Biden gets the presidency, then they can easily, like a lot easier to pass a stimulus bill. That did not happen, but yet the market continued rallying higher like it did. And so investors are really just buying because it's buying. Like there's no, again, there's no, it's complete decoupling from fundamentals. It's only driven by liquidity and inflation. And in my opinion, I expect a short-term sell-off to realize the implication of Biden presidency, not only because of the higher taxes, but also people who bought in thinking it will be a blue wave, that now the Senate looks like it won't be a majority controlled by Democrats. So that means there should be a little bit pushback, or maybe the stimulus bills will be smaller. They have to price that out. But I don't think this short sell-off will be the 50 and 80% big sell-off that I see for like the end of this whole crises, or like this. Like I don't think this is the end yet, since the Fed still have ability to come in with new program and massive QE. I think once the short-term sell-off comes in, maybe 20-30%, Fed will come in with more massive stimulus or massive asset buying, and that might push inflation expectation high enough that we start seeing that cycle where asset prices keep going up, and that's where we'll see that rally with inflation really kicking in. And that's this idea that I talked about before, where it just keeps going in terms of inflation until one point the Fed can't control inflation anymore, and there's only one thing they can do, which is raise rates, and that's when I think the final 50-80% drop will be. So I don't think this is it yet, but I do expect a short-term sell-off and followed by a rally once the Fed comes back in, or when Congress passes the next stimulus bill. Now let's talk about the US dollar. So what happened was investors were pricing in, if it's a Trump presidency, then a rally in the dollar, and so it sold off pricing in the Biden presidency. So if you actually look at the news right after the election, when Trump was leading, the dollar was rallying, and then when Biden was leading, then the dollar was tanking. It was a perfect correlation, really. I do expect a rebound in the next 3 weeks, so meaning it's by the end of November. Long term, I'm still bearish, but just not yet, because it's still missing some key pieces. The bond bubble popping might do it, where investors who hold the U.S. bonds are in trouble. They have to sell. They have to get out of it. Inflation expectation picking up, so further devaluation of the US dollar, a significant stock market drop but investors are not buying into the dollar, and which could cause like foreign investors to just piece it, because the the currency exchange differential is not enough for the stock market drop. And then finally, the strength in other currencies. So something we saw with the UK central bank when they announced they're ramping up their asset purchase program. It's funny how when you promise to devaluate or more money printing, the currency rallies. So that kind of stuff can continue. But what I'm expecting is the US dollar, like by itself, will continue to be devalued and continue falling. However, the US dollar index, which is made up of the other currencies with exchange to US dollars. So I think all global currencies are falling. However, I think the US dollar will fall at like a slower pace, but everything will fall all currencies will fall comparing to real assets like um, precious metals. So now let's talk about precious metals. So we have seen a recent rally, especially this week, from probably investors looking for safe haven from the presidential uncertainties. Inflation expectation has still yet to be picking up. I'm expecting maybe mid-February, early March again from my previous videos of next year. And it's possible that we do have to price out some weak longs that we're anticipating a blue wave, because with a blue wave, again, expect like bigger stimulus packages, but because it looks like the Senate is not going to be majority controlled by Democrats, then the stimulus bills won't be that big. So we might have to price out some weak longs who bought on that. The key levels they still need to break above with gold 1980 and possibly even 2000. Silver at 26. They still have to break those key resistance levels. But one thing to keep in mind is the COMEX still has a massive open interest for December, and they have been taking deliveries, but the open interest is not going down. So I'm thinking perhaps after this 3 weeks, maybe a slight adjustment or consolidation, maybe a little bit of sell-off. Then once we hit December till year end with the COMEX, we could see a really big rally. But otherwise, I'm expecting early to like mid to late Q1 next year, which is mid-February to early March. Soon, just not quite. Really waiting for that next inflation indication. Either I'm thinking the leading indicator will come from agriculture goods, or if whenever the next stimulus bill comes out, I think precious metals would just take off. Speaking of agriculture goods, it looks like they're starting to rally from their consolidated phase, from the weather news coming out of Brazil and Argentina, with the rain finally coming in and they increased planting. Soybean needs to break above 1100 to start its wave B. Wheat is slowing down because it recently met its wave A target and it possibly need more time consolidating. But in my opinion, I still think wheat as a necessity will still be the leader among these three agriculture goods. Corn is struggling a little with oil supply being readily available and at low prices, as it has industrial use for energy. El Nino is still at play. The weather is still going to impact supply, and China is still buying. And so we'll see with the COMEX contract expiration end of this year, with soybean in this month and December for wheat and corn. Also, they have another delivery early next year, but I think it was in March. So we'll see when the supply shock really come in, or if it comes in. In my opinion, it should be coming in, and then that should start ramping them up in their prices, and which could lead to inflation expectation moving higher and pushing precious metals up as well. Now let's talk about energy. So oil is still struggling to break above $40 with Libya increasing production. Russia has been discussing another 3 months extension with OPEC Plus for oil cuts. So maybe that could prevent oil from dropping too low. And the Democrats, so these are short term, but now for mid to long term, Democrat push for green energy. Again, it will reduce supply of oil by reducing US production. Long term, it is very bullish, and in my opinion, I think we're going to see $100 barrel of oil again. For renewables, even though Biden had, when asked by Trump that he is not for the Green New Deal, even though he said, oh, it's great, it creates so many jobs. Even if they don't go for the Green New Deal, I think the more progressive candidates or progressive members of the Democratic Party will still push for some sort of package or assistance for the renewable sector. And I think that, again, along with oil, will be a good area to invest going forward. So in summary, I would not buy into the US bond market. I think it's just a matter of time until it blows up. Like, and come on, let's be real. Inflation expectation, Fed's promising 2%. Why would you buy, like, the 30-year is not even at 2%. Like, why would you buy a negative yielding bond? So, I would stay away from treasuries and corporate bonds. Those are pretty overpriced, not pricing in default risk. And also, because the treasuries are at negative real yield. US stock market, still overpriced. It has not priced in the Biden higher taxes, both in capital gains and corporate taxes. I'm expecting the rich, they might want to lock in their capital gains instead of normally you lock in your capital losses. They want to lock in their capital gains so it's not taxed as high in the future. Also, they get a higher cost base. US dollar short term, I think within the 3 weeks we should see a rebound, but long term still very bearish. But US dollar index might still go up because other currencies are falling quicker. So we might see both US dollar going up with a US dollar index going up with gold. Normally they're inverse relationship. This time I think will be different because US dollar will be falling, but not falling as much. So US dollar index can go up and gold will still go up. Precious metal, still a great opportunity. The big wave has yet to come, but really be mindful of short-term risks. And just waiting for the promise of or even news of stimulus bill or just inflation indication possibly coming out of agriculture. Energy, more bullish with Biden presidency, not only for green energy because they're green energy, renewable energy initiatives, but also the cut in supply for oil, as they don't like oil. So that would also push up oil prices, but oil really is waiting for the virus to pass as the supply overhang is still not being resolved with sufficient production cuts. So we shall see going forward. Best of luck.